Thanks, Mr. Carson. So my first question goes to the buffer. So you say in your submission that the buffer is an artificial loading that does not reflect a consumer's current capacity to service a loan at prevailing rates. The buffer cannot anticipate how a consumer might respond to rising rates by cutting back on expenses or securing additional employment. Lenders already buffer a consumer's capacity when performing their assessment of unsuitability to comply with the NCCP Act. And so borrowers are potentially subjected to buffers on buffers. So that is your submission. So what impact do you think this arbitrary approach has had on first home buyers or prospective first home buyers?
So it's twofold. The 3% buffer impacts everybody because it loads the capacity of a consumer to service a loan by 3%. The additional buffers that come in are generally speaking with financial institutions when they're looking at the income of applicants. They will look at the steady, reliable income and they'll take that, and they'll often exclude additional sources of income that may not be so reliable, and hence they strip out some elements of income that come into consumers' pockets, and then they'll also load the expenses of the consumer, and so you'll have various institutions approach it differently, but you'll have consumers will declare their own expenses. Those declared household monthly expenses will be compared against internal benchmarks or external benchmarks, and they may be increased so that the bank will infer that the customer spends more than what they actually do in order to bring them up to a highest level of expenditure. And so you've got financial institutions discounting the income, increasing the expenses of the applicants, and then on top of that, we're applying an additional 3% buffer on their capacity to service the
So what impact does
repayment
that have
of the
on first
loan.
home buyers? How does it impact first home buyers differently?
I guess the biggest issue is that first home buyers typically have smaller deposits and they also have lower income. And so those buffers and those discounts bite more deeply into what would be seen as that excess to service the loan. So where you've got a high income borrower, you can strip out 5 or 10% of their income and it does little to their capacity to service the loan unless they're right at the maximum of their borrowing limit. Whereas a lot of the first home buyers are really pushing into quite an expensive market. They already are coming with low deposits and generally from a lower income base. So when you take out small thousands of dollars from those applicants, it has a bigger impact on their extra capacity, which is what a bank needs to see to be able to approve the loan.
Okay, and then what about this idea of there being mortgage prisons? How does that manifest for people who are maybe paying back their first home loan?
Yep, so you've got people in the market now who entered the market when the interest rates were maybe 3%. So they were buffered at 6% and they could service. The markets went up to 6% and those customers have comfortably serviced or are continuing to service their loans. But now if they want to apply for a lower rate loan, let's say it's $1 million mortgage, that loan will be buffered at the prevailing rate of 6% plus it'll be assessed at the current interest rate of 6% and buffered at the further 3%. So they need to demonstrate capacity to service at 9% for the banks to be able to approve the refinance to a lower rate. And it's only the existence of the buffer that pushes them into an inflates their expenses beyond their current circumstance where they're actually servicing their mortgage at 6%.
So you're saying
into their current loan, they can't switch away because they can't demonstrate serviceability under the buffered loan.
Right, so even if there was a better deal with a lower rate, they couldn't move?
Not with that buffer. So that if they move to a lower rate, their repayments will drop a little bit, but the 3% buffer is much higher than what they would probably benefit from switching to that lower rate because the step down wouldn't be as extreme.
So what do you think should happen with the buffer?
So look, I recognise that the buffer is agnostic. It applies to everybody. And so to that end, I think that first home buyers need some differential treatment. They should be buffered less because really it is about the impact of that small increase having a bigger bite of what they've got as surplus to be able to service. And I think also, as we heard earlier, it makes sense to apply a lesser buffer to those who are demonstrating an existing ability to service their current loan at, say, a 6% rate, where we're further up in the interest rate cycle, more likely to see cuts. And so I think in relation to people moving at the moment, they should be able to move to a lower rate if they can demonstrate that they're servicing at their current rate. So in effect, you'd be applying the buffer that was applied when they entered into the loan several years prior, rather than applying the buffer on top of the rates that have increased close on 3% over recent years.
Yeah, but I mean, this is a very arbitrary, blunt tool that's being deployed. It seems to have a disproportionate impact on first home buyers, but also locks people into prisons.
And neither of those were intended, I think, for the buffer.
Yeah. But isn't APRA APRA is doing what it's been asked to do by the Parliament. I mean, APRA hasn't been asked to look at how it can help first home buyers. So isn't that right, that APRA is just doing what it's been asked to do?
Yeah, exactly right.
Yeah, so this is actually Canberra's fault. Canberra's created this.
Well, I think it may be an unintended consequence. I think the concept behind a buffer is completely sensible, and we can see that the use of the buffer in past times has contributed to the stability of the market, even in a rising rate environment. But it's relatively slow to respond, and we probably wouldn't want to get to a situation where government's trying to finesse the estimations of where interest rates are going so that it tries to cut it too fine. But I think we can all recognise that when we reach the top or near the top of the market, that a 3% buffer is fairly heavy. And it's also, we need to recognise there are perhaps categories of people who are impacted by the buffer in ways it wasn't intended. For me, it would be first home buyers and those that are trying to move to a better situation.